Most people sell their investments when they need cash, but the ultra wealthy just borrow against them. And when you borrow against your portfolio using something called a box spread, you can get cheaper rates than any other kind of loan out there. And this opens up all kinds of possibilities for the purchases of primary residences, a vacation home, a rental property, a car, etc. In this video, I'm going to break down why borrowing against your investments can be a game changer for taxes, and specifically how sophisticated investors do it. So let's say you have a few $1,000,000 invested in the stock market and you're sitting on a gain in all of your positions. Given what the public stock market has done for the past 10 to 20 years, it's very common for people that have been investing to have all of their positions marked at a gain. Well, if you need to withdraw from your portfolio, you're gonna need to sell some of those securities. And what that does is that triggers a capital gain, which you then have to pay taxes on, and then that sets you back. So let's say you need to grab from that multi-million-dollar portfolio $100,000 for some sort of down payment or a tuition. I was gonna say a tuition bill, but hopefully it's because you have multiple kids in private school and that's why you would need that amount of money. Or maybe you're buying a new car or something like that. You're actually gonna need to sell more than $100,000 worth of securities in your portfolio, because if you just went and sold $100,000 worth, you're going to owe taxes on that amount, and then the net is gonna be less than 100. So this is why wealthy families never actually sell their investments, they just borrow against them. Because if I borrow $100,000 against my portfolio in that scenario, I avoid capital gains taxes from selling appreciated securities. I leave those investments intact so they can keep compounding. And lastly, if you do it the way I'm going to show you, you can actually get a tax deduction on the interest expense on the loan. All right, so let's go through an example. And here's a handful of assumptions that I'm making for this example. It's a portfolio that's compounding at 10% a year. We're going to borrow $100,000 in the first example. Then I'm going to show you what happens if you're borrowing $500,000. Let's assume that you get a 4% rate on your box spread loan. Let's assume most of the people I work with are in the top tax bracket. So let's assume you're in California. Let's assume your positions in your portfolio are at a 100% gain. So for example, if you had to withdraw $100,000, you'd be triggering a $100,000 gain. That you're applying the 60-40 split between long and short-term capital gains for the deduction on the box spread loan, and the time horizon we're going to evaluate is over 10 years. All right, so here we go. We're walking through. If I had, instead of doing a loan, I sell the $100,000 stock, which is probably what a lot of you listening would have done. That means you're going to trigger $100,000 of long-term capital gains applied at this tax rate. That's a $37,000 tax bill. Now that's not all. There's also the opportunity cost of no longer having that $100,000 compounding in your portfolio. And over 10 years, $100,000 compounding at 10%, that equates to $159,000 or so of lost growth. So the total economic cost is the gains you triggered plus the lost compounding, and that's almost $200,000. All right, now let's go through option B. If you were to do a box spread loan against your portfolio, the costs of that are 4% interest. So you're going to owe $4,000 a year. I'll go through the mechanics of what that actually looks like later. So over the 10 years, that's a total of $40,000. However, you get a tax deduction in the form of capital loss with a 60-40 split. Now, another difference when you do it this way is that $100,000 you would have withdrawn actually stays in the portfolio and it compounds. Now, you should recognize this number. That was the opportunity cost. Now we actually keep it. So what is the net economic benefit of borrowing? Well, it's a $125,000 difference. All right, so leave it to Chat GPT to do stuff wrong. This just goes to show you it's unbelievably powerful tool, but when it comes to any sort of real financial planning that you're doing, you got to be really careful because it spits stuff out that is just not right all the time. So I've fixed it. What we're saying is now we're comparing the scenario where you sell $100,000 versus if you were to borrow $100,000. What's the 10-year impact? When you sell, you incur taxes and you lose the compounding. When you borrow, you incur interest expense. So the net differential between the two is over those 10 years, you would have an extra $162,000 in your net worth if you had gone the route of borrowing versus not. And if we go through the same example, same assumptions, but we just tweak it and say we're going to borrow $500,000 instead of selling $500,000, and that comes up, it's usually real estate purchases. So it's either, down payment on a primary residence or a secondary home is like how I've seen it come up with people at that dollar amount. And the net difference between those over the 10 years is $811,000. So what can seem like it's just a simple efficiency tweak that you're doing, that value add, the differential compounds over time. And so when you have this tool in your tool chest, it's just going to greatly enhance your growth in your net worth over time. Next, I'm going to dive deeper into what box spreads are and why they're the best way to borrow against your portfolio. But first, I want to be clear, this is something that 99% of people should not try to do on their own. Not that you should be trying to do anything that I talk about in my videos on your own, but especially this one. If you mess this up, you're going to have serious issues with margin calls and forced liquidations, and it will not be fun. So do not do this on your own. At QFS, we work exclusively with those that have $5 million or more in investable assets and have the ability to partner with some of the top investment managers out there, including ones that can execute these box spread loans for our clients. And whether you're a high income earner who's sick of losing half of your income each year to taxes, or you have an upcoming liquidity event that you want to plan for and reduce the capital gains, we have solutions that can meaningfully reduce your tax bills. If you want to see just how much we could save you in taxes, like unique to your specific situation, then go ahead and use the link in the description to book a call. Now, let me show you how box spreads work. And for this, I'm actually going to use my partner Synthetic Fi's materials that are wonderful for how to explain how this works. So if you know about put and call options, embedded in every option contract is essentially the risk-free interest rate. And you can construct a trade, which is a synthetic long, and then you can also construct a trade, which is a synthetic short. Now, if you put those trades together, what that does is you completely hedge out any underlying market exposure to the instruments you're using. In this case, we do it on the S&P 500. And if you drew a diagram of the payoff profile, it looks like a box. That's why they call it box spreads. So for example, it would just be these 4 options trades is what you would do to create a box spread. And so it locks in a fixed payoff at a fixed future date, and that becomes your loan. So essentially what you're doing is you're borrowing money directly from the options market. So you've cut out any sort of bank or financial intermediary that wants to stack their fees on top of whatever loan that they're giving you. You go straight to the market, and that's why the rates are so much lower. So for example, if you wanted to borrow $1 million for a 1-year term at a 5% interest rate, the way that a box spread loan would work is you'd enter those trades, you're going to receive $950,000 in cash, and then at the maturity of those options contracts 1 year out, you're going to owe $50,000 to close out the position of $1 million worth. So the way it works is you just get cash equal to the fixed amount minus the interest expense incurred over the term of the loan. This one's simple because it's 1 year, but let's say it was over 2 years, you would get $900,000, and at 5% a year on $1 million after 2 years, that would be $100,000. And a lot of times people be like, well, where's the money coming from? Well, it's whoever's on the other side that wants to be long a box spread. And so a lot of options market makers are doing that. A lot of hedge funds are doing that. The box ETF is just constantly rolling long box spreads. I guess that's something to explain. If you can extract this sort of risk-free interest rate. Now, in reality, you have a 20 to 50 basis points spread over the risk-free rate, usually depending on where on the curve or what your term is of the box spread you're doing in particular. But the BOXX ETF is just rolling short-term long box spreads. And so in theory, if you were doing a box spread loan, it's possible that on the other side of the trade is the BOXX ETF. And the point is you have so many different people participating in this market. It's the deepest, most liquid options market in the world on these SPX contracts, that the bid-ask spreads are relatively tight and you can get these really attractive rates. And as I said, with that 20 to 50 bip spread, that's why a lot of people actually prefer to be long box spreads as opposed to something like a money market fund, because you can actually get a pickup in your yield and have it be slightly higher. And the reason it's so cheap is hundreds of millions of these contracts are trading a day, and all the different market participants are competing for one another to be the one on the long side, essentially lending you this money. And there's a cute little visual here. Imagine it's just like a live auction where we go, hey, our client wants to borrow $500,000. What are you willing to lend us at? And someone says, I'll give it to you at close to 5. Someone says, no, I'll go at 4.83. So what you do is you hit whichever person is willing to give you the cheapest rate for your borrow, and then on their side, they're long that. And we touched on this before, but I think this is a nice visual to show, depending on what the S&P 500 does. So what is the index price? Let's say it falls to 4,500 or it gains to 6,500. The way that the options contracts work is they're all gonna net out to the same fixed dollar amount, no matter which way the market moves, or the underlying, in this case, SPX. And that's because you've perfectly hedged out. So two of them are gonna expire worthless, and then the other two are going to expire either negative here. One's negative, one's positive, one's negative, one's positive. But every single time, no matter what the market does, you're always going to have the same fixed payout regardless. Said differently, no matter what happens with the index, the result is fixed at the strike price difference. And so the way it looks in your account is, if you had $1 million in SPY, you could trade a box spread and say, oh, I want to borrow, I'll get $95,000 cash. And then in the future, I'm going to owe $100,000. And so what will happen is the box spread will be in there as a negative market value. And then you'll just see an equal amount of cash is now sitting in your account. And what you're able to do is you can then pull that cash out of your account to use it for anything that you need. Or what some people do is they're gonna buy more investments in their account. Last visuals I want to share from them is showing you how the tax treatment of these are. And so this one's showing $10,000. So imagine you borrowed $10,000 over 1 year. You get this cash up front, and then at maturity, you owe this amount back. The way it goes is it gets a 60%, 40% split, long-term capital loss, short-term capital loss. And that's because SPX index options are Section 1256 contracts. If you really want to know, you can look that up for more detail. Now, let's say you're borrowing over a multi-year period. We haven't shown this yet. Over time, so let's say it was $10,000 that you entered into. You owe in 3 years $10,000. Well, you would receive less cash up front. So you've got $9,700. And then these are just visuals showing the tax treatment. So on average, about each year, you're going to realize a $100 capital loss. That's just automatically going to be done on your statement from, Schwab or Fidelity. It's just going to show a $100 capital loss. No money is actually changing hands here. It's not like you owe $100 to anyone. You just owe this amount at maturity, but it's showing, your box spread, those 4 option contracts that are outstanding is going to show a negative $9,700 balance. Then it's going to show negative $9,800, $9,900. And then as it gets, in bond terms pulled to par, it would show negative $10,000 at maturity. So like if you're a bond person, you can think of this as you're essentially just short a 0 coupon bond. And this is the sort of imputed interest each year is going to show up as a capital loss. All right, now let's talk about the risks with this strategy. And in reality, the risks are no different than any other sort of margin loan that you would be doing. But if that's something you're new to, what's the most important thing is that your collateral, the investments in your account, you want that to be as diversified as possible to reduce the volatility and a max drawdown that you think it could experience. Because if it draws down too much, that's when you're going to get a margin call and the custodian is going to say, hey, you need to deposit more cash in your account, or we're just going to start selling some of these securities. So let's say you have a 100% stock portfolio. If you have something called portfolio margin turned on, it's going to increase your margin of safety. And you put a box spread loan of 30% against the account, like your LTV is 30%. The stocks, the collateral in your account would have to fall by over 64% for you to get hit with that margin call. So that's a pretty wide margin of safety. The second you start increasing your LTV, the percentage drawdown that your collateral could sustain before a capital call starts to get smaller. So I'd say that's the biggest thing is before you do your box spread loan, make sure you understand exactly what the drawdown is that would have to occur for your collateral for you to get margin called. And most people, you do not want to deal with that. So always just be conservative in it. Another risk that I don't think everyone understands is if I have $100,000 in my brokerage account and I borrow, $50,000 against it, I've essentially decreased my liquidity. Even if the investments I hold are daily liquid, they've got to stay in the account to back and be collateral for that loan that I created. And where that can get tricky is if suddenly you need to withdraw from your account, you're essentially going to increase your LTV as you withdraw the equity of your account. And so that's another thing I would say to be careful of is it's not like a point in time lifetime LTV. It really matters everything else that's going on in your financial situation. Is money on its way into the account, in which case you're going to be de-levering yourself over time as you're dropping more money in the account and making more investments? Or are you going the other way? Are you at a point in your life where you're actually withdrawing more from your account? Then I don't know that this makes the most sense, at least not at higher LTVs, because you're going to keep increasing the LTV as you withdraw from your account. And so those are all things that consider, and life happens to people and you're gonna need to withdraw from your portfolio likely. I mean, for people I work with, you've got your emergency fund of 3 to 6 months annual spend set aside. So ideally that's where you would be going if you truly needed liquidity, but you just always want to be careful because you never know, and margin calls aren't something you actually ever want to deal with. Not fun. I'm just going to go through a couple case studies of what we've done for people so far using these. A big one for people is the spread above the 10-year treasury on a 30-year mortgage is quite large today. And so the difference between a mortgage at 6 point something percent today and a box spread loan of 4%, that's a big difference. So for a lot of people, if they're going and buying a home, we're going to actually use partly their portfolio to finance the down payment, make a larger down payment to decrease the size of this expensive 6% plus mortgage over here. And what you can do is your blended debt, some of it is 6, but now some of it is 4, you're gonna bring down the interest cost over time. And we call that a hybrid mortgage. It's a hybrid because you're combining a traditional mortgage with a synthetic loan against your portfolio. And another interesting wrinkle with that is for, your married couple out there, you can only deduct the interest expense against your taxes, itemizing it. Up to $750,000 on a mortgage. That sort of cap doesn't apply to box spreads. So for some people, it makes sense, max out the amount of debt on your primary residence up to that $750,000, and then plug the rest of the gap, what you need, with a box spread, and then the entirety of the debt outstanding is tax deductible, assuming you're going to have a use for the capital losses on the side of the box spread loan. Another area where this has come up multiple times is in shifting or rebalancing a portfolio of someone that comes to me. A lot of people that come to me, what they really want to do is they want to use the tax-aware hedge fund, so they're getting deductions against their ordinary income, whether that's while they're working or once they stop working, and we want to do tax-free Roth conversions where we shield the income realized on the conversion with a deduction from the hedge fund. Or what they want to do are these long, short, tax-aware SMAs that are just harvesting large amounts of capital losses each year. But if you come to me with these sort of locked up portfolios where you have really low basis index funds, single stocks, mutual funds, it can make it very hard to rebalance or get cash to invest in any additional strategies we want to do. What the box spreads allow for is a sort of a bridge loan that, let's say it's usually less than a year what we need, because we can create so many deductions from the investments we do that it removes the friction of taxes. But if you want to get started right away, a box spread loan against your appreciated securities frees up this cash that can then be used for these tax-aware investment strategies that are going to reduce your tax bill. So if you're serious about looking at doing a box spread, just go ahead and go to my website, and I've got a tab called financing, and on here I actually explain a little bit more about how the box spread loans work. And then where are we? If you look here, you can check today's rates, and here you can see at the different durations what the current rate is. So if I wanted to borrow at around a year, that's kind of what I was talking about, close to 4%. Now you can go all the way out, I guess I never said that. You can borrow month to month floating, or you can go all the way out to about 5 years. So if you wanted to borrow for this duration, it's actually going to be a little bit cheaper. It's more like 3.7%. And this is going to be updated daily. So if you ever want to just look at the rates available today, just go to my website and then click on that. All right, that's it for today. Thank you guys so much for watching. If you want to learn more about the sophisticated investment strategies that those with millions and millions of dollars in their portfolio are doing, be sure to subscribe to my channel, and I'll see you in the next video.